Hello, this is Ignorant Entrepreneur, and today I wanted to take a look at trading through October. The stock market is set for a turbulent month of trading this October, according to LPL's senior market strategist, Ryan Detrick. Last week, Detrick outlined how historical data shows October being the worst month of the year when a presidential election is held. During an election year, stock prices tend to be weak from now until late October, said Detrick, adding that this is the weakest time of the year. Now, with the first and second week of October going by, and along those historical trends, given that the market fell with news about President Donald Trump and the First Lady Melania Trump, who both tested positive for COVID-19. The news comes just a month before a highly anticipated election and adds uncertainty, risk to the pre- and post-election investment landscape. But investors shouldn't look to sell out of the market in anticipation of a potential negative October because the year-end outlook remains bright, according to Detrick, who cited historical S&P 500 data dating back to 1950. First, the fourth quarter is historically the best quarter of the year for stocks, with average gains of 3.9% and stocks up 79% of the time. And on top of that, during the fourth quarter of an election year, stocks are up an average of 2% and are positive 82% of the time. But most importantly, strong performance in the third quarter tends to bode well for the fourth quarter, according to Detrick. Typically, the third quarter of the year is weak for stocks, having posted an average gain of 0.6 and been up 61% of the time. But in 2020, this wasn't the case, with the S&P 500 delivering a return of 8.5% in the third quarter. When the S&P 500 has seen strong third quarter returns of more than 7.5%, the fourth quarter posted an average return of 7.3% and was positive 100% of the time, according to Detrick. The third quarter is usually weak, but when it is really strong, like it was in 2020, this says the rally isn't over yet, Detrick explained. Now, with all this being said, trying to time the market often doesn't turn out well. Spooked retail investors wind up selling at lows after buying at highs. They then face another decision, when to buy back in, and wind up sitting on cash and missing out on market gains. Take March, for example, when the S&P 500 plunged 34% in a matter of weeks. Anyone who sold at the bottom on March 23rd missed out on a 16% rally by the end of the month. All that being said, it looks like a lot of the sources that I've been reading and in touch with have suggested that you continue to hold, diversify, and prepare for insane volatility. I'd like to hear about your thoughts on this. Like, subscribe, and comment. Let me know more. All right.